Hello Deep Value community, thank you for watching. Today I want to talk about why the best company is not necessarily the best investment. So if you're new to the channel, please subscribe so you can get my next video installment. Remember, this is our value investing journey. So let's crack on. In today's topic we're going to talk about valuations, cult stocks, businesses, how to describe them, and investing with fear. So it's always critical to think about what you're paying for the business. This is the most important aspect of investing. People get infatuated with certain stocks or certain companies. That's not the right way to think about it. You got to think about how the business's fundamentals are performing over time. Next, it's important to take a longer time horizon than just looking at businesses, how they performed in 2017 and 2019, because that was a bit of a abnormal investment period. The number of written stories about value investing being dead in the period of 1998 to 2000 and the pieces that were written in 2017 to 19 seem to echo each other. Whenever a bull market is hyperextended, many investors believe that doing the art of investing through value investing is out of fashion. Next, let's talk about cult stocks. So a cult stock, aside from the ones that like Tesla and other ones that you know very well and I will not name, and don't make necessarily for a good return to the investor. Now, there are enough outliers to lead investors into believing that that is the right way to go. Everyone looks in hindsight and says, oh, Amazon did really well. And even if you'd invested at the peak of 2000, Amazon is an outlier. Apple is an outlier. These are very few and far between companies on the global stage. To expect that your run-of-the-mill software company is going to be the next XYZ, it's not common sense. You got to invest in a way that you think, I'm putting away capital today for that business to take the capital and grow. If you think about it from a business perspective, how the business is going to expand, you're going to do much better over time. Everyone wants to make strong returns, but the way to do it is to act like a businessman, right? You got to think, how is the business going to sell more services, more products? Don't think about the stock. That's the worst way to approach it. That's the end game. Start at the beginning. How is the business going to perform over the next 2 or 3 years? Moving on. Try to invest in businesses that you can explain in 10 seconds. Don't use any jargon. Don't use any company rhetoric. Just focus on trying to explain to your friends in a business-like way, in an elevator pitch, how the business can perform. Don't say, oh, this is a great business. That's the wrong way. Try and say, okay, for example, Apple sells iPhones. iPhones have a strong ecosystem. Bang, that's it. Try and make it really simple, 10 seconds. If you can't explain it, then you're most likely not investing. You're just speculating. Try to understand how the business is going to perform. Moving on. When you are deploying capital, the best way to compound strong returns is through the fear of investing. You have to be absolutely terrified of a loss of capital. If you're not willing to be afraid of losing capital, then you're speculating. You got to be able to say to myself, okay, I can withstand, let's say hypothetically invested in Apple. I have no position in Apple, but hypothetically invested in Apple, and if Apple goes down 50%, that's fine. You believe that Apple is one of or the best business in the world, and it's going to grow back up. If you're investing in something slightly smaller and it goes down 50% and you get afraid, then you should not invest in the first place. So it's important to have this type of difficult thinking, asking tough questions before the investment takes place. So I hope you found that useful. Please subscribe for our value investing journey. Goodbye.